everybody. I know you're eating.
I actually started giving those out as closing gifts.
Go ahead.
Tim Arrowood here, People's Home Equity, mortgage guy. So I'm gonna yell loud so the folks across the wall can hear me. So, who of you have heard of Brian Buffini? Who knows who Brian Buffini is? You heard of Brian Buffini?
It sounds familiar.
He's a real estate coach,
Yep.
and he has Buffini and Company, and he is, according to him, he is the one of the biggest coaching company in the country for real estate. So I'd heard about him for years, and the other day I found his podcast, and so he's an interesting fellow. I mean, it's all about relationships and things like that. But I was listening to him on the way down here. I got some other stuff to talk about. I was going to talk about 100% financing options and things, but he said something I wanted to is kind of the fun part of the non-technical part of things. And he says, when the vision is clear, the decisions are easy. When the vision is clear, the decisions are easy. And so he was talking about when you know what you want to be, when you want, where you're going, the decisions that you make in business and life are just easier, And so I thought about, one of the things that we talk about all the time. We've got, if you've ever been to our office, we got them on the walls and stuff. We want to do a ton of communication. We want to close on time, and we want to guarantee the numbers. So when he mentioned this, when the vision is clear, the decisions are easy. It made me think of a situation we had about 2 weeks ago. So we screwed up. Basically, what happened. So we had a client that was closing Friday at 11 o'clock, and I had pre-qualified the client and told them they needed to get $6,000 in seller-pay closing costs. They didn't get $6,000 in seller-pay closing costs, but we didn't catch it, right? So everybody, I didn't catch it, Kim didn't catch it, Joel didn't catch it, the underwriter didn't catch it, everybody. It's like it was a comedy of errors. We get down to the day of closing, and the listing agent says, we didn't agree to $6,000 seller-pay closing costs. I'm like, you're right. You didn't. And the borrower was going to have to bring $6,000 extra to closing, right? So, so I find this out. We have a team meeting every morning at 9 a.m. So it's either 15 minutes or 30 minutes. And so, Kim tells me we do video. Even if we're in the office, we'll do video because they're afraid of anything. So she says, we missed it, 6,000. And so, I've got the listing agent scrambling, the buyer's agent scrambling, the borrower's concerned, and I said, well, what do we? The only thing we can do. They're looking at me like, what do we do? I'm like, well, the only thing we can do. So I gave them a $6,000 lender credit, right? But it was easy to do that. I mean, it was not easy to do that, let me tell you. It wasn't easy to do that. But it was easy because we preach it all the time. Who wants surprises at closing, right? It's the borrower's fault. Well, if I caught it in the first week, it'd been the borrower's fault, right? You didn't get the closing costs that I told you to get. It could have been the buyer's agent. You didn't get the $6,000 that I told you to get. But after that first week, it's not their fault anymore. It's my fault. It's our team's fault. So as I heard him talk about that, when the vision is clear, the decision was really easy. It was painful, but it was easy. There was no other option. We just had to give him a $6,000 credit, right? Take a deep breath, give him a $6,000 credit because that's what you do, right? So, but I think about it, that just really struck me on the way down here. And, it was good for a couple of different reasons. Now, once you make that decision, then it's like, okay, let's have a talk with the team and say, well, this is what we're doing, this is why we're doing it. Because we preach it all the time. If we screw up, that's our job, is to make sure that we fix it. And so they were able to see me make that decision, not much of a hesitation, we just have to do it. We could have said, well, Mr., how about the buyer's agent, maybe you give a little bit, and then you do a little bit, we'll give a little bit. It wasn't any of this, it wasn't their responsibility. And so it was, the team was able to see, well, I preach it all the time. We want to communicate, we want to close on time, we want to guarantee the numbers. And when we guarantee the numbers, that worked. So now, at that point, I talked to the buyer's agent. Talked to her a little bit, but the listing agent happens to be, she owns a small office up in Kingsport, and I was explaining to her, I said, we're gonna take care of all of it. She said, all of it? She said, well, we could do this. I said, no, and so what went from, a lot of pain went to, that was a wow, right? We talk about, I've talked about before with you guys, like raving fans, right? You wanna get people to say wow, not wow. It's kind of felt bad. It's like, well, we screwed up, but we fixed it. Can you say, pat me on the back for that? So, but I figured if we're gonna, for $6,000, we ought to at least be able to milk it a little bit, So, but what turned, it was, the buyer was happy. There's gonna be referrals. Listing agent, or the buyer's agent was happy. The listing agent has an office with maybe twice as many as you all have. And she says, oh, don't worry, I'll tell everybody. And so, it's what we do, and that wasn't the reason I did it, but, the following through on those things, it felt kind of good. But when the vision is clear, the decisions are easy. So, and Buffini was talking about, on the way here, I was listening to him, he was talking about, knowing what your customers are. So, is it, I just, I've said for years, life's too short to work with jerks. So, it's easy to, that's just not who I work with.
What are you doing?
Well, that's the very reason I am here, is because you guys are special. And but it makes it easy when, yeah, there's lowercase s in special, and then there's an uppercase s in special. So have I ever told you the story about, no, I tell stories all the time. So, anyway. Speaking of special, I gotta tell this. Okay, this has nothing to do with mortgages, but I gotta tell you. So, I was in 5th grade, and my mother gets a letter from the school district, and says, we're gonna put Timmy in a special class. And my mother, bless her heart, she thinks I'm
A lot of sense.
well. Yeah, she says, I knew it. He's slow. Right? That's what my own mother, that's the first thing that comes to mind. I knew he was slow. I knew he was slow. She calls a friend of hers that works at the school, the superintendent's office. And she says, I got this letter and I'm so concerned. And she just laughed. She said, no, we're putting Tim in a gifted class. But my own mother said, oh, I knew it. I knew he was slow. So that's what I've had to overcome all these years. Anyway. I had to tell the story. So get off the philosophical stuff and get into the boring stuff. And it is 11:25, so I'm not going to take a lot of time. I was going to talk about 100% financing. I did update, you guys, I've shared this with you before, but I've updated this. There's new loan limits. For example, new loan amounts, we're at $548,250 for conventional loans, so that's up from 510,400, I think it is. So it used to be if you had a loan amount of over 510,400, you had to get a jumbo loan. So it made it more difficult to get those loans. There was a time this year that people just stopped doing jumbo loans. So if you have listings, that opens up the door to a higher price house, is what basically what it says. There's also FHA loans is now the max loan amount is $565,362, which is up, $20,000-$30,000. So we're seeing some significant increases in property values. So I think those are some things. I made this a little different color. It was supposed to be plum. I don't really know what it is, but this would, so that you would differentiate. If you got an old one, you can throw the other one away because the numbers are up. Also, like the maximum household incomes are increased for THDA and for USDA. So those are all marked in here. So I'll have some of these for you guys. So there should be one for everybody. What I was going to talk about today was 100% financing. So I've already spent some time last time talking about VA loans, which is one of the 100% financing. So I'm not going to spend a lot of time on that. But there are other people, other lenders have other types of 100% financing. But the three other 100% financing options I have is USDA, THDA, and what's called the Chenoa Fund. And they're all down, well, the USDA a standalone product. The THDA and Chenoa are down payment assistance programs where you have a first and a second. Basically, an FHA loan that requires 3.5% down, a THDA will give you a second mortgage that sits on top of that to cover that down payment. Turns it into 100% financing. So right now, there's pros and cons to all of them. So THDA, for a long time, their rate was high, and so we were trying to put as many people in USDA as we could because their rates were lower. But now THDA has changed their program a little bit. So you've got, it really helps when it comes to the way it's set up. You've got an FHA loan with 3.5% down. The rate right now is 2.75 for 100% financing. So that's hard to beat. The other thing that is really helping because there's so much price pressure right now with we're trying to have the best offer we can when it comes to you don't want to ask for too much in seller pay closing costs, right? So that's a big thing. Well, if I'm going to ask for $8,000 in seller pay closing costs, then that it's difficult to explain to the borrower. It's difficult to negotiate. It's so competitive these days. So THDA, if you're buying a house, if the purchase price is under $150,000, then it is a flat $6,000 second. So if you're buying a $95,000 house, which I don't know if there are any out there these days, but you still get a $6,000 that credit covers. So it not only covers the down payment of 3.5%, but it also you can use that to cover a lot of your closing costs. So you may end up seeing for 100% financing that somebody only needs $3,000 in seller pay closing costs on a THDA loan. So that's a big advantage. Now, once you're over $150,000, then the amount pops up to $7,500. So that helps. So if you're buying, if you're in the low 100s, you're not going to have that much out of pocket. You're not going to have that much out of pocket, or you're not going to have that much that you're going to need to negotiate seller pay closing costs. And then if you're 150, 160, then you're getting an additional $1,500 to cover that. So when they're payment, they're looking at the principal and interest for the first loan, the principal and interest for the second loan, and then taxes and insurance, and then there's also mortgage insurance. So, but the rate being 2.75 right now, and that's set by THDA. It is what it is. So it's very stable. Usually changes about once a month, once every 2 months, as opposed to other rates that we see which are bouncing around every day, right? You may be up or down a little bit. So, so you guys are pretty familiar. Everybody here, has everybody done a THDA loan? No?
Helps them take
So
the class.
maybe half of them? What's that?
So it helps someone take the class.
Oh, it's, yes.
Very unmotivated.
So when you look at these, you're going to see that, speaking of THDA, you've got, you can still get the max of 6% in seller pay closing costs. There are maximum household incomes. So, for example, in Washington County, if you have 1 to 2 people in the household, then they can't make more than $69,000 a year. If there are 3+, you can make $80,500. Yeah, absolutely. Yeah. Sullivan, Carter, Green, Unicoi, Hawkins, and Johnson. Those are all a little bit different. So you'll see when you look at this, next to those, there are some targeted counties, and they're trying to encourage people to use the program in those counties. But you can see in Hawkins, Johnson, and Greene County, you can make 1 to 2 people, you can make over $80,000 a year and still qualify. And if there's 3+ in the house, then there's going to be, you can make up to $93,000. So it's a pretty it's one of the best programs right now. So let's see, what else about there? You got to have a 640 credit score. It's based on an FHA loan. So all of the 100% financing loans, as you might imagine, when I'm talking to clients about 100% financing, I tell them, when we're lending, we're always talking about risk. So if you imagine that if you don't have any skin in the game, if you're doing 100% financing, then the risk is already a little higher than it would be for somebody putting 20 or 30% down. So when the risk is higher there, then we want to lower the risk, so we want to raise the credit score requirements. So the minimum being 640. So if somebody's got a 580, 590, 600, anything below 640, I'm going to, the only real option is either a VA loan or an FHA loan that's going to require some money out of pocket. So, and as an aside, not that I'm asking for this business, but I just closed an FHA loan, and the client had a 569 credit score. Like I said, I don't advise it, but she just didn't pay her bills on time. So she made $200,000 a year. She had 10% down. Her debt to income ratios were low, but she had a bad credit. She just, just put your stuff on bill pay or something. So, I don't know. So, her closing gift was Dave Ramsey. Is what that was. Get out of debt. You make all kinds of money. I mean, it's crazy. So, but my point is that what happens in that when you're looking at that is, well, if you're going to put more money down, then we perceive less risk. The system, I tell clients all the time that we just want to know that we're going to get paid back. So, but we have to have rules to figure out what that looks like. So, one of the ways to look at that is, well, if you have a lower credit score, then let's raise the requirement for how much money you put down. But it's all intertwined, so it's difficult. I don't necessarily need for you guys to understand. You need to understand the concepts. It's for me to figure it out because it's hard enough for me to figure it out with all the tools that I have. But when we're looking at 100% financing, you're going to see that we're going to need a 640 credit score. So that's the THDA. Is there anything else about THDA? Have you guys had any good or bad or other? I mean, the ones that have done it at THDA. There's an education requirement, as you mentioned, and I don't know how much that is. It might be $50, $100. Okay, usually it's done online. My own daughter, when she bought a year and a half ago, she used THDA, and the only thing is that she procrastinated doing the education. So that's what family's supposed to do, is not do what you tell them. So and so there was, at the time, she had to get some sort of confirmation by somebody local, had to have a phone call. It was just a waste of time. I mean, I know they're trying to make it to where the borrower is learning something, they're not getting into something that they don't understand, but it was just a waste of an hour and $50.
It's essentially like when you buy a house, like try to ease up on buying Lamborghinis for no reason. Like, don't go buy a bunch of new furniture right out of the gate.
So
just
close.
Just so close. So now there's for the Chenoa Fund.
What is
again,
Chenoa?
It is based on
Is that fairly new?
What's that?
The Chenoa? It's fairly new.
Yeah, it's probably maybe the last year and a half.
Okay.
There was a different program that was set up for that went away with all COVID hit. I mean, a lot of the 100% financing stuff, it was, we locked up. The whole industry locked up. It was like high risk. We don't want that. So there was a time when we couldn't even do THDA because there was the possibility that somebody could take the forbearance that was going on at the time. They could buy a house when the first payment's due, ask for a forbearance and not have to pay their first payment for, they could buy a house and not have to pay payments for 6 months. And so there was a lot of concern that was going to be the case. So there was a time when we couldn't do THCAs, and then I think we may still be doing it, but because of the risk of that, the way it works in my branch is that I could choose to not do them, or I could do them but share some of the risk with corporate. So what happens is I've got a maximum of $15,000 that I put into an escrow account when I do a THDA loan, and as long as they make their first payment on time, I get that money back. But if they don't make that first payment, then I risk $15,000, right? So it's one of those things I don't, I do a lot of them, and usually people are excited. They at least make the first payment, right? They may not make the second payment, Christmas, and I lost the bill, but it's, but they're sharing the risk with us. So that is actually tapering off, but who knows with the new COVID stuff going on, what'll happen. So that's THDA. The Chenoa Fund, it is the difference in it does have a second mortgage associated with it, but it's only 3.5%. So with an FHA loan, you need 3.5% down. So Chenoa, you get a first loan for the FHA loan for 96.5%, and then you've got the Chenoa Fund, which would loan them 3.5% to put in. So at that point, then we've got to get, it doesn't cover any of the celebrate closing costs, or it doesn't cover any of the closing costs. So the borrower either needs to come up with their own money, or they need to ask for those. Now, the reason that we would do the Chenoa over a THDA is sometimes it's really, it'll say that we can go down to 620. I've never done anyone down to 620. I need to fix that, because technically we can, but it's so expensive. I'd rather tell somebody, let's get your credit fixed and get you up 20 points, as opposed to trying to do that. What was it about? Okay, so there are, with the THDA, you have to be a first-time home buyer. So a first-time home buyer technically is, you haven't owned a home in 3 years, in the last 3 years. So you could have owned a home for years and years and years, and then you sold it 3.5 years ago. Now you're a first-time home buyer. So you have to qualify for that. Now the Chenoa, that's where we'll get around that. So Chenoa I can do in Virginia, THDA I can't. Some of those things. So USDA I can do in Virginia, but the THDA I can't.
Do they not have a VHDA?
There is. I've done one of them. Okay, and I think we were the first one in the organization that ever did a VHDA loan, and it actually went pretty smooth, but it was brutal on our end. And so we'll probably, if we have to, if somebody got started in a USDA loan in Virginia and something happened that they didn't qualify for whatever reason, but they did qualify for a VHDA, then we would do it. But we're not promoting it. So we did one, and I knew there was something up when I talked to a couple of people. I said, we had those available. I said, oh, really? Yeah, the last one I had, it took, like 3 months to close. I'm like, oh my goodness, what are we getting into? So it went okay with us, but it was, we were having to educate our own internal staff, our own internal underwriters, and it was, the risk was too high. My thought is always about our reputation. So you guys really don't care whether we've done one or not. You just want it done. And I appreciate that. Everybody does. You're expecting us to, if we say we can do it, we do it, right? So I'd rather say, no, we can't, or I've never done one before, but I'll try, if you're okay with it. So you know that this could be ugly, So the reason that I would do the Chenoa is when somebody, if they don't qualify for USDA, because USDA doesn't care if you're a first-time home buyer or not. You just can't have, you can't have a current home and then buy another one using USDA. So the Chenoa would be, it's either going to be Chenoa or USDA if you just sold a house. Chenoa, so it's pretty much an FHA loan with those limitations. And you can see, well, they may be qualified for USDA, but they had a bankruptcy 2.5 years ago. Well, USDA won't allow that, but the Chenoa would. So that's the things that we're going through, different layers of, well, how about this? Well, if this, then we can do this. So that's the reason that it gets a little complicated when we get into it. And sometimes people won't tell us, or it won't show up when we pull their credit, that it's been, the dates might be wrong. So I might pre-qualify somebody and have a wrong date, and then when we get into it, we start to vet all this stuff. It's like, oh my goodness, it wasn't 3.5 years ago, it was 2.5 years ago. Somebody put a date in wrong on the credit report, and so that flags this. That's what can happen sometimes, and we try to go to great lengths to make sure it doesn't, but there's a lot of moving parts. Let's see. And then we've got USDA, so that's probably one of the more common ones. How many of you all have done a USDA loan? I had a customer that's done. So, most people. So it's a great program, low interest rates, low mortgage insurance. The problem with it is that the debt to income ratios that they allow, it's more conservative. So whereas a THDA loan will allow 45% max debt to income ratio, Chenoa will allow up to 50% debt to income ratio. A USDA might be 28, 33, something like that. So it limits what we can do. And so again, that's another thing that we're juggling to say, well, yeah, you're qualified for USDA, but you can only buy up to 140. But if you want to go to 170, then okay, that's going to end up being maybe THDA, and you moved to Virginia. Well, now it has to be Chenoa because you hired debt to income. So those are all the things that we're chasing as we go through that process. So I really like the USDA. Obviously, it takes longer. There's another layer of underwriting. THDA and USDA both require, we do our underwriting and get it clear to close, and then we hand it off to somebody else. THDA will do it in about 24 hours, but USDA could be 2 days, it could be 2 weeks. It's outside of our control. I mentioned the other day, there is they've consolidated what used to happen is that we would package up the loan and we would send it to Nashville, and their underwriters would look at the file, and then they would get back to us. So we could look on the USDA website, and they would tell us, well, we're working on files that were received on such and such a date. So in the last year, they've consolidated things, and they don't do it on a state basis. They probably have the same people in place, but they maybe do some load sharing. So there is now there's an address, and I don't think it's on here, but I think I mentioned it maybe Joey the other day, that you can go and you can find out, well, we are working on files that were received on this day. So that's important. If you're not working with us, I've seen Kim in my office send out an email, we sent it on such and such a date, you can check the website right here to see where they're at. If you're working with another lender, one of the keys, I've seen it through the years, it's like, yeah, just wait on USDA, they're bad, they're terrible. And what's happened is that loan officer they're using USDA to cover up the fact that they didn't get it done, right? So it's taken them forever. Well, if you know when it went in, and you can look at that website, you can be able to check the loan officer. Now, give them a couple of days grace period, but it's not gonna be 2 weeks off. So that's one way, if you've got a file that you're waiting for it to come out of USDA, then you can say, well, tell me the exact day that it went there, and then I know where to go, and I'll get you that
It is on here.
It is on here? Okay, cool. It may have,
Additional USDA.
yeah, so now I need to change that. So you've got, one is for Tennessee, one is Virginia. That is one thing that changed. So even though it's asterisk number 4 on the back, I think that's incorrect now. I think I need to get you so you guys you'll get rid of 2.
You give us the old version.
Well, this is hot. This is actually literally hot off of the
Who
laminator.
who got the right version?
Well, nobody yet, evidently. So, but that'll be changed. That'll be a place where you can go and check that out. Okay?
Let me make a call real quick, see if somebody else got it.
It's all right. It's all right. I'm not sensitive. So I wouldn't be here if I was sensitive. All right. So and again, we're looking at maximum household incomes. For the longest time, USDA was the highest one. Where for up to 4 people was 90,300, and 5 plus you make 119,200. But THDAs are creeping up there. So those are all things that we take into account when we're trying to figure out whether which is the best option for the customer. So the big thing about 100% financing, as I think about it, is that it is inherently more risky, because if you're not putting any money down, it's more risky for us because there's less, people don't want to let their houses go, but if you don't have any money in it, then it's more risky. And then many times people come and say, well, they've got $300 to their name and they want to do 100% financing. Now, it's not impossible to do that, but it is really difficult, because we have to very, very exactly calculate what their closing costs are, and then in turn that we've got to get exactly what we need from the seller in order to facilitate closing costs. So we may, in order to make something like that happen, what I tell clients is, even if you're doing 100% financing, I want you to have from $1,200 to $1,500 in the bank. You're going to have an earnest money deposit. It's somewhere around 500, depends on what your agent says is best for this particular one. You're gonna have the home inspection, was it $350 to $450 for a home inspection? It's gonna cost you to move. We wanna show that you've got some money in the bank, so you look stronger. So I'm telling people that I want them to have between $1,200 and $1,500 in the bank. We want you to end up with money, not having to bring that much money. But in that case, it takes the pressure off of having to exactly calculate what those closing costs are, because it depends. They may find a place in the county, in the city. It may the odds days interest. It could be plus or minus a couple $100. And what happens is, when that happens, we get down to the end and they don't have the money, so I end up having to give it. So I've learned to right. I'm not going to let it not close for $200, right? So that'd be silly, right? So I'll end up eating it, so I don't mind to do that, but if I can avoid it, it'd be more better. So, what do you think? Does that make sense? Any questions?
I like it. So instead of the Genoa Fund now is a fund set up by,
I don't know, Genoa.
Is that one that was like the Lakeview?
yeah.
That went away. Yeah, Lakeview
That
went
died.
away. Yeah, so it may come back. So that, I don't, honestly, I don't remember where it started.
I don't know about this new Russian one you got here.
Fish
Did it
church.
start in Chernobyl?
Yeah,
Yeah,
that's what I just said.
the Chernobyl Fund. Yes, it's for, it's for houses that are irradiated, and so,
Radon will be high.
yeah. Well, we have a special loan for that one. Yeah, so, honestly, I don't remember. I don't know who has it, this particular program, you know, but, you know, there are other lenders will have, you know, their own 100% programs. You know, Eastman's gonna have their program, different one's gonna have their one, you know, so, any questions?
That's super helpful.
Well, good. Good. When the vision is clear, the decisions is easy. So I like that. I just thought I would share that. So that's all I got.
Thank you, Tim.
Thank you very much.
Well,